This lecture is over stock valuation. I'm your professor, Dr. Stephen Haggard. We can value stock the same way we value any other financial security, and that's using our basic rule. Remember that the value or price of anything is the present value of the expected future cash flows discounted at a rate appropriate to the risk of those cash flows. So let's talk about what the future cash flows of stock are. Well, you can receive dividends, which is where the company mails you money in the mail, a check, or you can benefit from proceeds on the sale of shares. So therefore, the stock value is merely the present value of the expected dividends and the expected proceeds from the sale of shares. We can develop a model for pricing stock starting with a very basic thought. What if we have a stock that's going to pay a dividend at the end of this year, and then we know that we could sell that stock for a certain price? Then the price of the stock today would merely be the present value of that dividend and the present value of the price we could sell the stock at in 1 year. And that's what this first formula really says. P sub 0, that means price at time 0 or price today, is equal to D1, that's the dividend 1 year from now, divide by 1 plus R. Now that whole D1 divided by 1 plus R is merely the present value of that dividend. And that 1 plus R is to the T power, but in this case T is 1 because we're only working one period into the future. Similarly, the present value of the price you can sell the stock for at time 1, P1, we get the present value of it by dividing by 1 plus R. And so when we add those two present values together, that gives us the price of the stock today. That is our definition, that the price or value of anything is the present value of the future cash flows. Now, there's only one problem with this. Who can tell me what the price is going to be at time period 1? If you have this special gift, please let me know, and we'll work together to become wealthy. But so far, no one has been able to correctly predict stock prices 1 year in advance. But you don't need to worry, because now we can put P1 in terms of D2 and P2. And that's what the second formula really says. That the price of the stock at time 1 is merely the present value at that time of the dividend received at time 2 and the price of the stock at time 2. Now, once again, we're in a problem because actually forecasting the price at time 2 is more difficult than forecasting the price at time 1, so we really haven't helped ourselves. But the good news is we can keep doing this on and on and on, and that is how we're going to develop our model. The general idea is that we could go on forever and ever and ever, pushing out the date at which we need to know the future stock price. And if we push it out far enough, its present value becomes almost nothing. You remember this formula for present value, future value divided by 1 plus R to the T? If T is large enough, the divisor becomes so large that the present value of that future stock price is almost 0. And so we can, in effect, ignore it. We don't need to worry about it. So we can actually sum up our new pricing model as saying that the stock's value is merely the present value of all future dividends. We don't have to worry about how much it's going to sell for at some date in the future. Okay, now that we know that we can value the stock using only its dividends, we're going to examine 3 different dividend payment patterns and develop a method for each one to value stock. The first is called zero dividend growth, in which dividends don't grow at all. In other words, they remain constant. The second one is constant dividend growth. This is where the dividends grow at a constant rate. And the third one is called differential dividend growth. You may also hear this called supernormal dividend growth. But now you're probably asking yourself, why in the world do shares have a positive price for stocks that pay no dividends? For example, Apple Computer. They don't pay dividends at all. How can they have a positive share price? Well, that is because people expect them at some point in the future to start paying dividends. and today's share price is merely representative of the present value of those expected future dividends. The stock doesn't have to be paying dividends today in order to have expected future dividends. Our first dividend growth case is zero dividend growth, which is also known as constant dividends. Now this is actually a good model for preferred stock. Preferred stock pays an identical dividend over and over and over again, and it doesn't have a maturity date, so that set of payments goes on forever and ever and ever. Now, I think before we've talked about a constant stream of identical payments. We had a special name for that, and it was a perpetuity. And we had a formula for finding the present value of a perpetuity. If you recall, the present value was C over R, where C was the identical payment amount and R was the required rate of return. So we can easily adapt this to finding the price of preferred stock. Because remember, the price or value of anything is merely the present value of the future cash flows. So in this case, the price of the preferred stock at time 0 is equal to D over R, where D is the recurring dividend and R is the required rate of return. Next, we'll discuss the constant dividend growth case. This can model some types of common stock, for instance, the common stock of utility companies, because we might suspect that utility companies' earnings and their dividends would grow perhaps at the rate of inflation. What we're really looking at here is a stream of payments that grows at a constant rate and goes on forever. We have a name for something like that. It's called a growing perpetuity. And if you remember what our formula for growing perpetuity is, its present value equals C sub 1 divided by R minus G. Now that's a little different than our last formula, so let's talk about the differences. C sub 1, that's a cash flow at a given time. Because these dividends are growing all the time, we can't just say any dividend and use it. We have to specify which one we're talking about. And it's the one that happens at the end of time 1. The other thing you're seeing here that's different is the G. That's the growth rate of the dividends. That's that constant growth rate. Now, mathematically, R needs to be greater than G in order for this formula to work. Now let's put this in terms of dividends. So we're going to say the price at time 0 is equal to the dividend at time 1 divided by parenthesis R minus G close parenthesis. And so that P sub 0 is today's stock price, D1 is a dividend payment at time 1, R is the required rate of return, and G is the constant growth rate of our dividends. Now, something that may happen to you on a quiz or an exam. Perhaps I'll give you D0 instead of D1. You shouldn't panic though, because you can easily convert D0 into D1 by multiplying by 1 plus G. After all, these things are growing at a constant growth rate, so you can always find the next one by multiplying by 1 plus G. Now, how do you know the difference between a D1 and a D0 when you're reading a problem? Well, if they say something like the dividend a year from now or the next dividend paid will be, that's D1. But if they say the last dividend paid was, or the stock just paid a dividend of, that's D0. So you need to read the question carefully in order to get the right answer. In fact, this is the biggest source of frustration students have with these problems, is they'll be given a D0 and they'll slap it into the equation as a D1. And of course they're not going to get the right answer. And if the problem is particularly tricky, that incorrect answer will be one of the choices, so don't be trapped by this situation. One of the neat things we can do with this constant dividend growth formula is to rearrange it for R, or the stock return. And this is going to break down stock returns into two parts. And so just through some simple algebraic manipulation, I can get to R is equal to parenthesis D1 over P0 parenthesis plus G. Now that breaks down stock returns into two components. That D1 over P0 is known as dividend yield. That's the dividend yield of the stock. And the G on the other side is the growth rate. Now, we said there was two ways you could make money from stock. One is from receiving dividends. The other is by the stock price going up. We call that a capital gain. And so what we find out here is that the stock return is composed of this dividend yield plus the capital gains yield. And so by default, G has to be the capital gains yield. Well, that's just the rate at which the stock price grows. And so this is a pretty neat outcome. Now we see that for a stock with constant dividend growth, the stock price grows at exactly the same rate as the dividends. Let me say that one more time. For a constant dividend growth stock, the stock price grows at precisely the same rate as the dividends. That's a pretty amazing outcome and would be very useful to you on an exam. Okay, now let's discuss the third case, which is known as differential or supernormal dividend growth. For newer companies, the dividends might grow at a faster pace until the market matures, then slow to a constant pace. For example, right now, Facebook. Facebook is growing like crazy, but we know eventually that growth will slow. Well, if Facebook were paying dividends, we might expect to see their dividends grow at a faster pace until that market matures, then slow to some sort of constant pace. In these situations, R can actually be less than G for short periods of time. If you recall from the constant dividend growth model, we said R had to be greater than G always. But we're not in the constant dividend growth mode here, so R can be less than G for short periods of time, usually the beginning of the period we're going to examine. Now here's the sad part. There is no slick algebraic method for solving these. And so the best way for me to teach you how to do these is to work through an example. But here's the process. The first thing we're going to do is find the individual dividend amounts up to the start of constant growth. And then we're going to find the price of the stock at the start of that constant growth. And we're going to use that constant dividend growth model to find that price. And therefore, what we've got is the present value of all the future cash flows. All we're going to do is find the present value of these dividends and that stock price. So we're all going to bring all those dividends and the final stock price back to time zero, add them together, and that will give us the value of the stock. Okay, so here we go with an example for differential or supernormal dividend growth. The problem reads like this. The company plans to pay a dividend of 1.15 1 year from today. That's D1. Then, over the next 4 years, that dividend will grow at 15% per year. After that, the growth will settle down to 10% per year. And so the question is, what's the value of one share of the company's stock today if the required return is 15%. Now, I am a visual thinker when it comes to these problems, and I think the very best thing that you can do when you get one of these supernormal or differential dividend growth problems is to start by drawing a picture. So that's what we're going to do next. Okay, so here's the picture. Start out by drawing an arrow going up to represent a cash flow at time 1 for that $1.15. Now the problem says that it grows at a constant rate of 15% for the next 4 years. Now, I never can remember if that means going to period 4 or period 5, so here's what I do. I take my finger, I call this the kindergarten method. I take my finger and I trace where the red arrows are. 1, 2, 3, 4. And that tells us where the last cash flow is that is affected by that 15% growth rate. So I'll go ahead and draw those in. And that means that the constant growth begins immediately after time 5 and goes through the rest of all time. And so this picture will help you to be able to visualize how this all works. So I highly encourage drawing a picture. Okay, so step 1 of this problem is to find the individual dividend amounts up to the start of constant growth. Now they told us that the first one was equal to $1.15. Just take $1.15 and I'm going to store it in location 1. That puts it in memory location 1. Now, we know that this thing is going to grow at 15% per year. So the way I figure out what the next one is to take the current one and multiply by 1 plus that growth rate, which is 15%. So I'm going to recall 1, I'm going to multiply that by 1 plus the 0.15, and so my dividend at time 2 is actually 1.3225. I'm going to store that in location 2. Now moving on to the dividend for the third time period, I'm going to multiply by 1.15 again. And that gives me 1.5209 roughly. I'm going to store that in location 3. And then for the dividend in the fourth period, I'm going to multiply again by 1.15. And I'm going to store that in location 4. And finally, for the fifth dividend, I'm going to multiply by 1.15, and I'll store that in the fifth memory location. Now you'll see why I did that very shortly. Okay, step 2 is to find the price of the stock at the start of constant growth. Remember that constant growth starts at time 5. Therefore, we need to find the price at time 5. Now that constant dividend growth equation we used earlier gave us P0 based on a dividend at time 1. Similarly, we can say that P5 is equal to D6 divided by R minus G. Now, we can rewrite P0 as D0 times 1 plus G divided by R minus G, because D1 is just D0 times 1 plus G. Similarly, we could say that P5 is equal to D5 times 1 plus G divided by R minus G, because after all, D6 is just D5 times 1 plus G. Now, when we've already got all the information we need to figure P5, we know what D5 is, we've already calculated it. Now be careful here, because the growth rate we're going to use in this calculation is the new growth rate of 10%, not the old one. So when we plug this in, we find that the price of the stock at time 5 is equal to basically $44.25. Okay, now we're going to use your TIBA 2 Plus to find the present value of these dividends and the stock price. Now we could have found the present value of each one of these using the formula PV equal FV divided by 1 plus R to the T, but it's so much easier to let your calculator do the hard work. There's your calculator, and we go to cash flows, second, clear work. Now the cash flow at time 0 is 0, so we're going to leave that as is, and I'm going to arrow down once. The cash flow at time 1 is equal to dividend 1. We have that in memory location 1. Recall 1. Now I've got to hit enter here, or it's like it never even happened. I'm going to arrow down. F01 is the number of times that cash flow shows up in a row. Well, it only shows up one time in a row, so we're going to leave that at its default setting of 1. So I'll arrow down again, and I get to C02. That's the dividend at time 2, so I'm going to recall 2, enter. Gotta hit enter, or it's like it never even happened. Gonna arrow down. Once again, that does not repeat, so we'll just leave that as 1. I'm gonna arrow down again. This is the dividend at time 3, so I'm gonna hit recall 3, enter. Arrow down, arrow down. And the dividend at time 4 is in our memory location 4. Enter. Arrow down, and finally in time 5 we have two things. We have the dividend from time 5, which we have in memory location 5, plus we have to add what we would get if we sold the stock at that time, which is 44.2499. Got to hit the equal sign here so the computer can do its work. Then we've got to hit enter, or it's like it never even happened. If you don't see this equal sign here, then you know that the calculator doesn't have it in its memory yet. Okay, now the goal of this whole exercise is to figure out what the present value of that set of cash flows is. To do that, we're going to hit the button that says NPV, which stands for net present value. And we were told earlier that the required return for this set of cash flows is 15%. So I type in 15 and I hit enter. If I don't hit enter, it's like it never even happened. I'm going to arrow down 1 and hit compute. And the calculator tells me that this stock is worth $27 per share after I round to the nearest penny. One of the issues we run into is being able to estimate G. If we're going to use the dividend growth model, we need such an estimate. And there are two basic methods to do this. First of all, we could look at the historical average dividend growth rate. And that could be a useful way to do this if you don't expect the future to be different than the past. Once again, electric utilities might be a decent example for a company like that. On the other hand, you might also try to get to it mathematically by taking the retention ratio multiplied by the return on retained earnings. So in other words, how much of our earnings are we retaining, and then what kind of return are we getting on those earnings? And that's just B, the plowback ratio, multiplied by ROE. So there are your two methods for estimating G. Now, one thing we have to be careful of when we're using the dividend growth model, errors in the estimation of G have a huge impact in our estimate of the return required of a stock. So think about this. What if our estimate of G was 1% too high? Well, then our estimate of R, the required return on the stock, would be 1% too high. Now, could that make a difference in our valuation of the firm's future cash flows? Absolutely. When you have a higher R, you're going to have a lower present value. What's even more dangerous would be if you estimated G too low, because then your present value would be even higher, and you might think that a stock was undervalued when in fact it was correctly valued by the market. Let's talk now about how growth opportunities impact stock value. And to do this analysis, the first thing we're going to do is talk about a firm that has positive earnings but no growth opportunities. We call such a firm a cash cow. Now, if the firm has no growth opportunities, they have no need to retain any of their earnings because they have no projects to fund. So it should pay out all of its earnings as dividends. And that set of dividends should resemble a perpetuity. Why? We know it's not going to grow any, and it should go on forever and ever. Therefore, the value of a share of such a firm can just be calculated like a perpetuity. Now, we know that constant dividends are valued as D over R, but in this case, since all the earnings are paid out as dividends, we can replace dividends with earnings per share. And so we have the price at time 0 as earnings per share divided by the required rate of return. That is the share value for a cash cow. Okay, let's see what happens when the firm has growth opportunities. If the firm has growth opportunities, the value that those opportunities would add is measured by their net present value. If you have $1 million firm, market value of equity, and you take on a $200,000 net present value project, the new value of the firm would be $1.2 million. NPV just adds to the firm's value directly. So we can also put that on a per share basis. All we need to do is take NPV of the growth opportunities and divide by the number of shares outstanding. And in this way, what we can do is find the new value of the firm's shares. All it is the cash cow value plus this net present value of growth opportunities per share. Okay, let's talk about the PE ratio. We already talked about the PE ratio back in Chapter 3. It's a measure of how much investors are willing to pay for $1 of current period earnings. Now, PE varies between companies and industries. Why? Well, we can use this NPV-Go model to find out. So there's the model. P sub 0 is equal to, that's the cash cow value, plus NPV-Go. That's a per share measure. If we divide both sides by earnings per share, what we get on the left-hand side, because that's price per share divided by earnings per share, the per shares cancel out and we get P over E, which is the PE ratio. Then over on the right-hand side, EPS cancels out and we wind up with 1 over R plus NPV-Go divided by EPS. And so there are really two things that drive PE. The first is the riskiness of the cash flows, because as that R gets bigger, PE will get smaller, all else equal, because R's on the bottom. Now we can also see that the larger our NPV-Go is compared to EPS, the higher PE is going to be. So the greater the growth opportunities for the firm, the higher the PE ratio. This helps explain a lot of the differences that we see in PE ratios for firms. Let's take a look at some PE ratios from different companies in different industries. I've chosen this group so you'll be able to see the range of PE ratios and how wide it can be. First, let's start with ExxonMobil. ExxonMobil is a big oil and gas company, and their PE ratio is 12.6. Now, at this point, is oil a great growth area? Well, it was a few years ago with the advent of fracking, but energy prices as of late have come down and stabilized, and so there's not a lot of growth at present for oil producers. Moving on, we have Ameren. This is a company that provides electricity to St. Louis, among other areas. And utilities typically have lower PEs because they don't experience the same growth that other industries might experience. Most of the time, electric utilities expect their growth rates to go along, say, around 2% per year or so. So there's not a lot of growth for electric utilities. Then we have gold mining. Gold mining is a higher PE activity. Apparently there's more growth possible there because you know that mining has to be more risky than producing electricity. The higher risk would predict a lower PE, so this higher PE than Ameren must be due to the potential growth for Newmont mining. And then we have Starbucks. Starbucks has a relatively high PE due to its growth. Starbucks isn't growing as much in the US as it used to, but it's growing rapidly overseas, and so that's why it has such a high PE ratio. Now I want to demonstrate how two companies in the same industry can have different PE ratios and why that might be. Walmart's PE ratio of 14.57 is markedly lower than that of Costco, 26.63. Primary reason here is once again the growth opportunities. Walmart is almost everywhere they can be in the US, but Costco is concentrated in certain areas, so they have lots of opportunities to expand. Then looking at Apple and Lenovo, you might expect that Apple would have a higher PE ratio due to higher growth prospects, but apparently it's actually Lenovo. Lenovo, by the way, is a Chinese producer of computers and smartphones. Then we have Yahoo and Google. This is an interesting story because back in the late 1990s, Yahoo was where it was at. Everyone thought Yahoo was the greatest thing since sliced bread, and back then Yahoo had a very high PE ratio. But what's the market telling us today about Yahoo's growth prospects versus those of Google? The market's betting on Google to be the winner in this fight. Then we have two companies from the pharmaceuticals industry. Pfizer at 23.72 and AstraZeneca at 64.92. In the pharmaceuticals industry, analysts like to talk about the manufacturer's pipeline. These are drugs that are in development that are just about to go to market. And if we were to judge by PE ratio alone, we would assume that AstraZeneca has a much better pipeline than Pfizer. Now I threw in Amazon and Alibaba here. Alibaba is a Chinese, basically, version of, it's a combination of eBay and Amazon and some other things, but it's similar enough to Amazon. We could compare them, except for one thing. Amazon was losing money in the most recent quarter when this PE ratio was calculated. You don't calculate a PE ratio when the firm is losing money because it would be negative. You also don't calculate a PE ratio when a firm has no earnings, because then the PE ratio would be undefined or infinite, depending on whether you ask an engineer or a mathematician.